Joining us right now for more on the markets and the reopening trade as May gets underway is Barry Knapp. He's managing partner at Ironsides Macroeconomics. And Barry, we've been talking about a lot of different headwinds and tailwinds facing the market these days. Obviously, if you're concerned about inflation, that may lead you to think one thing. If you're also watching just how much money is pouring in and potentially going to be there to prop up some of these stocks, just federal spending that keeps coming. Which side of this debate do you take right now? How do you see things?
So I'm in the, and I hesitate to call it inflation camp. I'm in the reflation camp, and I think that's where, you know, there's a whole bunch of hyperbole about how to think about what's likely to happen as a consequence of higher commodity prices, higher inflation over time. We had 3 decades of disinflation. We're moving into a period of reflation where prices are going to rise. I've drawn the analogy with the early 1960s. JFK gets elected. He's got a mandate for stronger growth. They have expansive monetary and fiscal policy. Prices started to rise, but what that meant for equity investors in particular was earnings. The PE of the market had gone from 7 at the end of World War II to 20 by 1960. It stayed at 20 through 1967 because earnings growth accelerated from 8 in the 50s, which was a very uneven decade, much like the 10s were, to 15 and stayed there until inflation became a big problem. So that era of reflation was actually very favorable for equity investors, not favorable for bond investors, which is why, you know, we've talked about the 60-40 portfolio, you know, approach being a problem for the next several years in particular. But this period of moving from disinflation to reflation is actually fairly favorable for equity investors, at least for a time.
And for a time, you mean years. You're talking about years that this could really run for equities before you have to pay the piper on any of these fronts?
Yes, I mean, that's my broad thesis. Now, we'll have to pay the piper on a series of occasions between now and then, in particular, when we get monetary policy tightening. So there's been this debate recently. A number of the strategists at some of the mainline firms have talked about a 10% correction. If you go back to the last cycle, the catalyst for all the corrections were monetary policy or fiscal policy tightening. So it sort of brings you back to the discussion you had with Libby Cantrell earlier this morning. When will the market price the tax hikes? For me, you can go back to the Tax Cuts and Jobs Act, first year of the Trump administration, for guidance on that. The bill was ultimately signed in early January. The market started to price it in early November. So we need to be, you know, roughly 2 months away before that whole thing takes shape. And we have what I think will be probably a 10% correction related to that. We'll get at least a 10% correction when the Fed starts tapering asset purchases as well. Friday's number looms fairly large in terms of the implications for monetary policy. But again, I'm thinking after Labor Day before they even talk about tapering. So, you know, you're into a period where you're unlikely to have a big setback. Now, could we trade in a range for a time? Of course we could, in part because, you know, we're reaching maximum earnings momentum. We're reaching maximum momentum in things like purchasing managers surveys. You know, Mike was talking about the market stalling out during earnings season for the last couple of weeks. That's plausible for me. But, you know, to get a big setback is unlikely until we really get policy tightening.
Shepard Smith here. Thanks for watching CNBC on YouTube.